Hey, Bill Lethman here for Money Evolution. In this video, I'm going to be taking a deep dive to help you to understand the Medicare surcharges called IRMAA that you could potentially get hit with if your income is above certain thresholds. And this may be something you're already a little bit familiar with here, but these costs can really get up there. In fact, if you get hit with this IRMAA, it could mean that your Medicare benefits could cost you 2 times or even more than 3 times the amount that they would if your income is not above one of those thresholds. So as I began this video, I started doing some really deep research on this, and I actually learned a couple of things and really started thinking about some added questions that maybe some of you have as well. So we're going to be diving into all of this today, answering questions like, well, what happens when I retire? Maybe you were making a lot of money and then you retire, and obviously maybe you're not making as much, and what happens? Are you still going to get hit with that IRMAA? Because one of the things about IRMAA is they're going to use the income that you made 2 years ago to determine how much you're going to pay for that. So we'll be getting into that. Or maybe you're already in retirement and you're deciding maybe to do some Roth conversions, and that's going to push your income potentially above some of those thresholds. Or maybe you just need to take regular withdrawals from your retirement accounts, and that's pushing your income up. So we're going to be diving into all of that and what causes the income to go up, how that income is actually calculated, and what type of income that they're using to base this IRMAA on. And then what happens if you do get hit with IRMAA? Do you have it forever? Does it go away? How long does it take for that IRMAA to drop off? So those are all of the things we're going to dive into deep. And this is something I refer to as a stealth tax. This is something that isn't really something that shows up on your tax return, but it is income related. So as your income goes up, this is the things that are going to affect how much you're paying for these Medicare benefits. And although not a tax directly, it is, like I said, one of those things we sometimes refer to as a stealth tax. So I'm going to get into all the details here, but before I do, if you'd like to learn more about what we do at Money Evolution, including some of our financial planning programs, we have some links down in the description below, including our retirement launch kit. So if you're getting into the retirement planning phase, that's a free set of worksheets and checklists that we developed to help you to get on track with your retirement and really answer a lot of those big questions and get organized for your retirement. So check all that out and let's dive into the video. So your IRMAA is actually going to be calculated based off of something called your modified adjusted gross income. And they're actually going to use your modified adjusted gross income from what it was 2 years ago. So I'm filming this in late 2025. So to calculate IRMAA, it's actually going to use the 2023 numbers for that modified adjusted gross income to see if you have any IRMAA that would apply. And IRMAA isn't anything that you're going to find on your tax return, but it is fairly easy to calculate. So we're going to actually start with adjusted gross income. That is something you can find on your tax return. It's actually line 11 of your 1040. And you're going to add back in just a couple of things. One of those might be any tax exempt interest from things like municipal bonds. And then probably not very common, but if you have any foreign earned income credits, that also gets added back in to get to that modified adjusted gross income. Now in retirement, things get a little bit more complicated as far as the different moving pieces of where that income comes from. Generally, while you're working, you have some income, you've got some expenses, and things are relatively set in stone. But we have a little bit more, or maybe a lot more flexibility as we go into retirement. But I want to talk just for a moment about where some of these different sources of income are going to come from as you're going through your financial planning. So adjusted gross income is going to include things obviously like your earned income or business income. So maybe you're retired, but your spouse isn't, or you have some consulting income or an ongoing business, Social Security, but that's going to be only up to 85% of that is going to be included in that modified adjusted gross income. Pension income, interest, dividends, capital gains, all of that stuff should be fairly obvious for your taxable income and calculating this modified adjusted gross income. Any distributions from traditional retirement accounts, Roth retirement account distributions are not included in this, so that's an important distinction. If you're doing Roth conversions and you have income from that, that's obviously going to be part of this. Rental income, or if you have an annuity, the taxable portion of any annuity payments would also be included in that. So as we get into maybe some of the strategies a little bit later, and I definitely get into this in other videos, is kind of mapping that income out and really controlling the income of where that's coming from. We talk about the 3 tax buckets and how you're taking distributions and when you're taking distributions to control not only your tax rate, but also some of these stealth taxes like this IRMAA that could really push those numbers up a lot. Okay, so let's take a look at how much this is actually going to cost. So up here on the screen, I have the Medicare Part B premium schedule for 2025. And remember, this is all going to be based off of what your modified adjusted gross income was in 2023, 2 years prior. So we can see this very top line of this. This shows us the baseline rate for Medicare Part B, and that's $185 a month. And if you're married, that's going to be for both of you. But we can see just with that second line down there where that first threshold of IRMAA kicks in. And it's going to be at $106,000 if you're filing a single tax return, and it's going to be at $212,000 if you're filing a joint tax return. But that kicks up those premiums by an extra $74 a month per person if you're married. So that's an extra $888 per month per person on Medicare Part B. That next tier down, which just goes up a little bit more, goes up to $266,000. If you're over that, it actually doubles your Medicare premium from that $185 to $370. In fact, that's exactly double there. And we can see later on, if you get above $400,000, it actually is over 3 times as much for that premium, and you're paying an extra $4,440 per year per person for that Medicare Part B premium there. So these are some things that you really want to be aware of. And unlike your regular progressive tax return that you have where you make $10 more and you go into that next tax bracket, you're only paying that higher tax on that extra $10. But here, if you go over these numbers by even $1, it's going to mean that extra $888 if we're talking about that first threshold, or an extra $2,220 if we're talking about that second threshold that you would hit for IRMAA there. So it really pays to really pay attention to where you're at in not only the tax bracket, but where you are in these IRMAA brackets as well there. This also is going to apply to your Medicare Part D premiums. That's going to be for your prescription drug coverage. And these have even steeper premiums. And while it may not seem like a whole lot, it does really add up. So if you get to that next premium there, it goes from $13.70 a month on the top of your regular baseline premium plan. It goes up to $35.30. That's an extra $423 per year. And again, that's going to be per person as well. So one of the things that I think sometimes can get people tripped up a little bit, you're trying to manage the IRMAA brackets and make sure you're not getting hit too hard with IRMAA, but also trying to manage your own individual tax rates, not only for today, but also out into the future as well. That's something I've talked about pretty extensively in a lot of other videos. And when we look at the IRMAA brackets alongside the individual tax brackets, they do look fairly similar, but they're not exact. And I think this is something that can really mess people up here a little bit. So we look at that top line there. So we know that you're going to start to get IRMAA affecting you if you're over $212,000 of modified adjusted gross income if you're filing a joint tax return, and $106,000 if you're filing a single tax return. We can see that roughly corresponds to this 22% tax bracket. But again, it's not going to be exact there. So this is the 2023 bracket because that's again what's going to impact what we're seeing here for the IRMAA in 2025. And we also have up here the standard deductions for 2023 as well. That's single $13,850 and married filing joint $27,700. So if we're looking at that 22% bracket, we can see that the top line of that 22% bracket is $95,375 for a single person. And if we add in the standard deduction, we can see that we can have $109,225 of income essentially and still be in that 22% tax bracket. Remember, sometimes when we're doing things like Roth conversions or taking withdrawals from retirement accounts, there's 2 tax tables that we've talked about pretty extensively in other videos, preference items and then non-preference items. So the non-preference items are what we're talking about here, and that's what's going to hit your actual bracket. But other things like qualified dividends or long-term capital gains are actually going to get taxed at a lower tax rate called the preference rate. But remember, modified adjusted gross income includes both of those types of income. It includes all income, essentially, that you're earning, even that tax-exempt interest from like municipal bonds. So we could have up to $109,225, and if we do the same thing for the married filing joint, we could have $218,000. So if you're trying to dial it in and you're trying to figure out how much money can you take from a retirement account, or maybe you're trying to do a Roth conversion and kind of go right up to that 22% tax bracket, that's going to get us into a little bit of trouble here, because the 109 or the 218 are going to be just above those thresholds where we're going to start to see that IRMAA kicking in. And although we did target the 22% tax bracket correctly, we went over by just a little bit. And it's not worth it to go over this just a little bit like it is sometimes with our regular taxes, because we go over that by just a little bit. Now our monthly premium on just the Part B jumps up from that 185 to 259. So we really want to kind of have a plan or have a system where we're really double checking and making sure that whatever income we have, and especially as we're getting later in the year and we're talking about doing things like Roth conversions or taking a distribution from your retirement account, that's going to be something to keep in mind so that it doesn't push you over the edge. And we could say the same thing if we looked at the 24% bracket, and you're probably going to get some IRMAA there, obviously, but we want to make sure that we're not going just a little bit over into that next IRMAA bracket, because that's a big jump and a big expense that you could probably avoid if we just are a little bit more mindful of staying underneath those thresholds. Okay, so one of the things I talked about at the beginning of the video is, what if I'm still working right now? I'm working in 2025, but I'm planning on retiring at the end of the year. But I'm making pretty good money, and I'm definitely making the kind of money that's going to potentially push me up into one of those upper IRMAA brackets, especially since they're going to be going back and they're going to be looking at what my income was from 2 years ago. Well, let's say I'm retiring at the end of this year, and next year in 2026, I'll be going on Medicare for the very first time. Maybe I'm just turning 65, or maybe I've been grandfathered in and I have an employer-sponsored healthcare plan that I've been participating in that's allowed me to opt out of Medicare for a few extra years. Whatever the case is, when I go to collect Medicare next year, they're going to be going back and looking at my income for what it was in 2024, 2 years prior. And again, if that's a higher level of income, I could potentially get hit with IRMAA. So there is a little bit of a way around this. There's actually a form that allows us to file an exemption or sort of a reset for that IRMAA. And you can only do this once, but it's going to be, again, a life-changing event. It's called SSA-44 is the form. They've actually got the IRMAA schedule right here on the very first page. But it can be for things like if you're getting married, if you're getting divorced, if you have a death of a spouse, if you're stopping work. And that's probably going to be the one that's going to apply to most people, a work stoppage, or they even have on here a work reduction. So if you're going into a partial retirement, or maybe you're retiring but your spouse is going to continue to work, whatever the case may be, you can basically fill this form out and say, here's what my income is going to be, is my projection for 2026, and then they're going to reset your IRMAA based off of that level. One very important thing to note on here, this is a form that you have to sign a sworn statement on. Under threat of perjury, you have to fill this information out as accurately as possible. You can't just say, I'm going to have lower income and really have something a lot higher. Incidentally, too, if we go back to these different events here, if we really got into the details, sometimes getting married might actually reduce the amount of IRMAA that you could have, because now you're filing a joint tax return. Or sometimes getting married, if you're getting married to a spouse that makes a lot of money, your IRMAA could actually go up a little bit. And that could be the same case for a number of these different life events. So you only really need to fill this out if you think your income is going to be lower. If your income does end up being higher, again, that's going to start that clock on that 2-year window, and then 2 years after you have that higher level of income, you're going to end up having to pay some of that IRMAA there. So this is a way to fill this out. A lot of people may miss this a little bit. They may not know that they can fill this form out, and it can really be a pretty big savings there when you think about it, and getting that reset as a one-time event. So let's take a quick look at a hypothetical example. And what I did here was really try to map this out and create a timeline for us so we can understand how these IRMAA rules work in practice. So we have a hypothetical individual. They're 60 years old right now in 2025, and they're going to retire at the end of the year. And because they're 60, they're not even yet eligible for Medicare benefits yet. So there's no reason to apply for Medicare. And there's no reason to do that SSA-44 form, because although this is a life-changing event, they're not eligible for Medicare, so this isn't going to apply to their situation. One of the things that we talk about a lot on the channel here, and one of the things we oftentimes recommend for our clients, is to look at the early years of retirement. And oftentimes what we see are what are usually low tax years. Again, at age 60, you're not even eligible for Social Security benefits to kick in yet. And you may want to delay those, not just to 65, but maybe to 67 at full retirement age, or maybe even extend them all the way out to age 70 to really maximize that benefit. And especially if you have some other assets that you can tap into, like non-retirement accounts, that can really give you a great opportunity to do what I call sometimes some asset shifting, moving money from those traditional retirement accounts to Roth retirement accounts through these Roth conversions. And so in our hypothetical example, that's exactly what we're going to assume that they're doing. They're going to take advantage of these low tax years in the early part of retirement for the first 5 years until age 65. And the only reason we didn't extend it further is because I didn't want to keep going out on my timeline here too much. So in all practical purposes, you may want to continue doing Roth conversions, but to make our illustration here, we're going to assume that they stop at age 65. Now, doing these Roth conversions is likely going to have a couple of different outcomes. One is we're hopefully going to save some taxes over the long run, over the rest of our lifetime, by basically taking advantage of low tax years now, and we might be in higher tax years later. It's also going to reduce our required minimum distributions. So those are the IRS rules that say that either at age 73 or age 75, we're going to have to start taking mandatory distributions from our traditional retirement accounts, whether we want to or not. And that, for some people, especially if we leave our traditional retirement accounts unchecked, those balances might grow to a point where those RMDs become a problem for us, both in the terms of higher taxes. We might hit higher tax brackets because of those RMDs, and also because we're going to hit maybe higher RMD rates as well. So doing those Roth conversions is likely going to be one of those strategies that could make sense for a lot of people. So at age 65, we're going to assume that they are now eligible for Medicare, so they're going to go ahead and apply for those benefits. But remember, the IRMAA rules say that we're going to look back 2 years prior to what the modified adjusted gross income was in 2028, and that's going to determine whether or not we have an IRMAA or not. And so at this point, if they were doing those high Roth conversions, we're going to assume that they were doing some IRMAA. So even though they stopped doing them in 2030, when they turn 65, they're going to still have to pay IRMAA for that first year of retirement, and because they're looking back to 2028. In 2031, they're still going to go back and they're going to look at what that was in 2029. And so we don't get until we get to 2032, where we're actually going to look back to 2030, and that's when our Roth conversion strategy stopped, and then we have our IRMAA reduced. That's one of the big questions a lot of people say is, hey, when I start paying IRMAA, do I have to pay it forever, or will it eventually drop off? Well, it'll drop off when and only when or if those that level of income drops below those IRMAA thresholds, looking back in a 2-year look back. So anyway, so we got into a lot of detail here. I certainly learned a few new things as I was going in and doing some of the research here for this video. I hope you enjoyed it. Don't forget to hit that like and subscribe button, and be sure to check out some of the links down below if you want to learn more about some of the financial planning that we do for our clients. We have links to all of that stuff down below, including our retirement launch kit. So if you're getting serious about planning for your retirement and you want to start getting organized, we have a great set of worksheets, including an entire retirement checklist that has all of the important dates, all of the different steps as you're planning retirement, including when you should apply for Social Security benefits, Medicare benefits, and basically everything else. So check all that stuff out, and I'll see you back in one of my next videos. Thanks.